TheoTrade. This is Don Kaufman. It's June 17th, 2019, and you are watching the TheoTrade evening video. The S&Ps today, well, they've been a little bit lackluster. Is that okay? I think we're just waiting on the Fed. I guess you could say the S&P futures are massively unchanged, but there is some movement inside of the market today worth kind of denoting. First of all, again, the S&Ps are massively unchanged, but what the entire trading day has really kind of come down to is a big capital rotation. It's the financials, which is represented here by the XLF, against the monsters of tech. If you have absolutely no idea what the monsters of tech happen to be, well, that's a conglomerate symbol. Mine made it. It's out of my mind. It's Facebook plus Apple plus Microsoft plus Google plus Amazon, okay, all kind of compiled inside of a ratio. And effectively, what you're seeing here, it's kind of a capital rotation. Let's get out of the financials and into technology. And really, to get specific, it's not all technology. I mean, all right, Google's up. Yeah, you got me. Amazon's up a little bit. It's a whole lot of Facebook. I mean, Facebook's up to the tune of 4.3%. On the back of what? Cryptocurrencies? Wow. I mean, it's like all over again. The market really has come full circle. We're back talking about cryptocurrencies, but have no fear. Actually, if you pull up cryptocurrencies, here's something fun. The CBOE Bitcoin futures, they're being delisted. I would pull up all the contracts, but there are no more contracts. In the next 2 days, the CBOE, it's Chicago Board Options Exchange, Bitcoin futures will cease to exist. And I've been in this business a long time. I've never actually seen them take a product away from people to be able to trade. But it's ironic that the CBOE is pulling the Bitcoin futures, and at the exact same time, that's why Facebook is actually rallying up some 4.5%. So really, I mean, trade today is this big capital rotation, but it's all about the Fed this week, and we're just going to put it right out there. And that's actually specifically what we're going to be looking at is just that. We're going to actually look at the bonds a little bit today, and specifically when I'm talking about the bonds, in this case, I'm going to go ahead and I'm going to use the TLT. Not everybody is necessarily bond savvy. I could pull up the ZB, I could pull up the ZN. That's the 30-year and the 10-year respectively. But in this case, we'll use the TLT, which is kind of a representative blend because it's the iShares 20-year, whereas this is the 10-year, the ZN's the 10-year, the ZB is the 30-year. It's kind of a blend of it, right? So again, I kind of stated my opinion about the Fed and the Fed announcement that is effectively coming out this Wednesday. And again, we're, waiting on the Fed here. And it's my inclination that a lot of the market's anticipation around this Fed announcement has been very much overblown. And by that, I'm talking about, the interest rates themselves. So the interest rates themselves, again, we're trading 225. 250. That's what the Fed fund futures happen to be. Now, right now, there are actually two Fed cuts priced in. Two Fed cuts are priced in for between now and the end of the year. My belief, it's really quite simple. I don't think they're necessarily going to go after two cuts, or at least they're not going to allude to two cuts right now. I do believe they'll probably give the marketplace, feed the ducks because they're quacking. They'll probably feed the marketplace one cut. But I'm not even entirely sure they're going to do that in the month of July. And that's what the marketplace is pricing right now. If the market doesn't get what it wants, the market will be angry. That anger could be taken out in the case here of the TLT and may actually see some sell side activity. Even if this doesn't play out the way that I think, and again, that's strictly my opinion. If it doesn't play out the way I think, all you need is over the next couple of days for the bonds to dip down and then rip again. That's fine. What I am doing in this particular circumstance is I am going to actually go after, a TLT in-out spread. Now, I go to the in-out spread. And what in-out spread really kind of denotes, it's one strike in the money, one strike out of the money. It means that I want to get directional. I want to get directional, but I only want to get directional in like the short term. Because many of you, if you kind of tuned in night after night, I'll do some bigger, what I term duration positions. This is not a duration position. This is me, taking a shot to the downside. Now, I know a lot of people, they're like, oh, they'll email me after this and say, well, did you pull up the Fibonacci? Did you have your MACD on there? Did it? Did the Fibonacci people make you do this? And yeah, I just can't get into it because you have to look at this for what it is. Okay, there's no technicals. There's nothing in the background here that's going to tell you, okay, what the Fed is going to do. Okay, all you got at this point is opinions. And I think at this point, the marketplace has given you its opinion. The marketplace believes that a Fed rate cut is like fully priced in. They're probably going to do 2 cuts. I'll take the other side of that. I think that the marketplace is, not necessarily going to get what it wants. I'm not saying the marketplace is wrong. I don't think the marketplace, though, is going to get fed what it wants. As such, I'm going to take a very short duration, bearish position. Short duration in this case is going to be 32 days out. And how I do that, turn around and I buy, a 32. So this is buying, again, a 132 out in the July 19th expiration. Turn around and sell a 130. Now this spread should be trading anywhere for around 99 cents to $1. I executed a bunch of them earlier. Okay, and again, we don't mind putting on a few spreads here and there. Fire at will. So I'm working another one right now at 99 cents. Okay, so you should be able to fill 99 cents, $1 in that neighborhood. Hey, maybe the bonds even rally up a little bit more tomorrow, give you a more advantageous fill. Again, all this spread comes down to is, let's bring up here and create a duplicate order, right? All I'm doing is buying a 132 put, selling a 130 put. Why do I do it? Because I'm trying to offset a lot of my extrinsic value. I'm trying to offset a lot of the volatility exposure. This is a pure delta play. And that basically means it's just a little bit of a directional strategy, okay? But I'm not trying to hit one out of the park over here. I'm risking 99 cents to try to make 55%. And I want to be crystal clear about that because a lot of people look at this strategy and they go, whoa, wait. Why would I want to go out, and risk $1, to make what? 55%. Let's just call it 55% on this. We'd be making basically 55 cents. It's because the probability, of making the 55% is drastically higher than losing the full $1. When's the only time you can lose the full $1? You can only really lose the full $1 32 days from now, right? But anytime in the next 32 days, if we just oscillate higher or lower, there's a really high probability of me making my 55%. So actually what we reference is not just probability of touching, it's probability of profitability. So you have to ask yourself, what's the probability of me anytime in the next 32 days of me making 55% on this particular strategy? And the answer is, it's a lot higher than losing the full $1, which actually, invariably makes this a good trade. People look continuously, I filled that one. People look continuously at risk reward. They don't ask themselves, what's the probability of profitability in this particular trade? With that, thanks everybody for joining us here at TheoTrade. Stay tuned. Again, there's a lot more to come. And then the Fed. Have a wonderful evening. Bye-bye.